Jared Dillian. Now you know a rich guy.
I'm Jared Dillian. This is the Jared Dillian Show. We're going to be talking about bonds. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. You can also go to my website, which is jareddillianmoney.com. Or you can follow me on Twitter at DailyDirtNap. And I can't believe that we're going to talk about bonds on the radio. Who has ever talked about bonds on the radio and made it interesting? But first, I want to comment that the stock market is up 30% this year. 30%. So if you invested $10,000 at the beginning of the year, and you now have $13,000. It's kind of tough to beat that. Kind of tough to beat 30% in the stock market. Now, it's a little distorted because the stock market dumped at the end of last year, went down 20%. So it's kind of that's artificially high number. Let's just put it that way. But still 30% in the stock market, which sort of encourages a lot of bad behavior. If there's people out there getting 30% in the stock market, it doesn't really make them want to look at other asset classes. And, you know, I just tweeted before the show. I said, if you are money manager, and you've had a few good years, my recommendation to you is quit while you're ahead. Go home. Take your ball and go home, because nobody ever quits at the highs. I can only think of like one person who has. It's Peter Lynch. He's a portfolio manager at Fidelity. The guy is, you know, one of the most successful portfolio managers of all time. He was also a simpleton. He used to buy the stocks of companies he liked. So if he ate at Chili's, he would buy Chili's. That kind of analysis doesn't really work anymore. Maybe it worked in 1996, doesn't really work anymore. So if Peter Lynch had stuck around for a couple of more decades, he would have stuck around long enough to see his reputation tarnished. So the one thing we can say about the stock market is that it observes a property called non-stationarity, which is it is a game where the rules of the game constantly change. So one thing isn't going to work forever. So if you've been long stocks for the last 10 years, and that's worked, it won't work forever. I can't predict when it's going to stop working, but it will stop working. And look, I guess I've been saying this for a couple of years, but it's pretty rare that you see the stock market go. It's not even 10 years, it's like 11 years straight. So nobody cares about bonds, and that's what we're here to talk about. Nobody cares about bonds and lonely bonds. In fact, people hate bonds more than ever because interest rates are so skinny. I bet that most of you don't own bonds. I bet that you do not own bonds. I bet that you, if you have your money in the capital markets, that you have it in 100% stocks with zero bonds, because that's what most people have. And why would you invest in bonds? Bonds only give you 2%. Stocks give you 30%. Why would anyone want to mess around with bonds? It's just common sense. First, let's talk about stocks. So what is a stock? If you own shares of a stock, you are a part owner of a company. So if you own 100 shares of Apple, you are actually an owner of Apple. Let's say your house was sold as a stock. So you sold 1 million shares and they all represented 1/1,000,000th interest in your house. If somebody bought 100 shares of your house, they would be a part owner of your house. If you own something, then you can dictate what happens there, and you can vote on votes in the corporation. You can vote. So your vote doesn't count for much because you only have 100 shares out of like 10 billion, but still, it's, capitalism, by the way, is not one man, one vote. Capitalism is $1, one vote. Yes. So what is a bond? A bond, if you buy a bond, you are lending money to Apple. You are functioning as a bank. You are lending money. You are a creditor to Apple. They're going to pay you interest, and after the bond matures, hopefully pay all your money back, just like making a loan. The difference between a bond and a loan is that you can buy and sell a bond, but you can't do that with a loan. A loan sits at a bank, and you can't trade it. And now there are some loans that can't be traded, but let's not get technical here. But a bond you can trade. It's a bond that trades in the markets. The bond market is many times bigger and many times more important than the stock market. And, to look at this, 1999, the dot-com bubble, stocks exploded higher, kind of like they are right now. And that bubble popped, and tech stocks went down 90% or more. The NASDAQ went down 90%. There were no economic consequences to this. We had a small recession. GDP was down 0.1%. It was barely a recession. There were no economic consequences to this. Now, if you talk about the bond market, if you look at the subprime mortgage problem in CDOs in the bond market in 2008, that blew up the planet. Bonds are way more important and way more dangerous. Back when I was just learning about money, back in 1997, I read a pamphlet. I didn't have a book yet, but I had a pamphlet. And what the pamphlet said was that when interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. And I said, okay, but I don't really know what that means. And it also said you should have bonds in your portfolio for diversification purposes. And people used to say that back in the 90s. And they don't say that anymore. Nobody says you should have bonds in your portfolio for diversification purposes. The financial advisors that are sort of lower tier, I'll just be generous here, unsophisticated. I mean, there are financial advisors that are very unsophisticated. And the less sophisticated financial advisors are the ones that are recommending very aggressive portfolios of all stocks. And so that advice, I don't know. Someone actually commented today that the stupidest people made all the money in the 2010s. Like if you just did everything that was really reckless and really stupid, then you got really rich, and that's pretty much true. One of the reasons that people don't take the time to learn about bonds is because there is some math involved, and it's not super, I don't know. I mean, look, if you go to college, there's a pretty good chance you're going to take calculus, and if you've taken calculus, then actually that's enough math to know about bonds. If you haven't taken calculus, it's a little tough to understand how they work. I was a math major in college, so the math was easy for me, and I teach finance in college, and the kids have a tough time with the math. Don't worry, we are not going to talk about bond math on the air. That would be impossible. But you need to own some bonds, or you're going to be sorry. By the way, if you want to call to talk about bonds, tell me about your portfolio. Call 844-305-7800. That's 844-305-7800. And let me tell you why. And this is all about diversification. We'll talk about this more in a couple of seconds. But diversification is pretty much the most important thing in the world. If you have a portfolio of 100% stocks that, by the way, just went up 30%, they can also go down 30%. It hasn't happened in a long time. 12 years ago, they went down 57%. Everybody has complete amnesia over this. And the idea here is to construct a portfolio that will perform well in all environments. And I spend most of my time thinking about this. I spend most of my time thinking about the portfolio that will continue to perform well in all of our. When I say perform well, I don't mean going up 30%. I mean, hanging in there. You want to construct a portfolio that hangs in there. And you need bonds for diversification. And we'll talk about this in a second. I'm Jared Dillian. This is The Jared Dillian Show.
Jared Dillian. Own your money. Own your life.